Hello, Marc Ostwald from ADM Investor Services International with some thoughts on central banks, above all a bit of a post-mortem on the ECB and a bit of a look ahead to the Fed and the consequences for financial markets. I'm going to kick off with the German 30-year yield simply because ahead of the ECB meeting we had started to actually have a bit of a reality check. This is a couple of days beforehand. It is now, the 30-year yield is now at a positive 0.08, so about 8 basis points higher than from my chart. And as we can see, there's a nice big fat gap down at the bottom, around about 1%. And the only real point in mentioning this is that QE isn't necessarily the great panacea that people think. People chasing bonds for capital growth rather than for a steady income are probably moving into the wrong territory. And the fact is we've got a 0% coupon on the new 30-year in Germany. So if we actually go and fill that gap from about the 99 price level we have at the moment, we would go back to a 72.5. That would be a capital loss of about 27 points. So you can have big upside capital gains and then downside also enormous. So let's move on to the next chart. This is the world stock of negative yielding bonds, all classes, so government bonds and indeed credit. As we can see, as central banks have sought to push back on the market's rather over-egged expectations in terms of policy easing, above all in the States, but to a certain extent in the Eurozone. So that stock of negative yielding bonds has gone back. I think there are 2 points here. First of all, the new ECB easing measures, for which there is a couple of big problems, would basically more than cover, along with the reinvestment, twice the expected issuance levels for the next financial fiscal year in the euro area. So people basically will be looking even more at riskier assets simply because even if the stock of negative yielding bonds starts to dip. But let's move on to the next chart or the next picture, which is about the Fed. But I want to just sort of have a recap on the ECB. Yes, Mr. Draghi did over-deliver in the sense that we've got a so-called QE forever and we got tiering on the deposit rate. But the QE forever doesn't actually necessarily work unless there's something else delivered, and that is a rise in the individual stock holding limits, which currently stand at 33%. For the ECB within the next 7 months, i.e. a challenge for Madame Lagarde to take on. Obviously coming after Mr. Draghi rolled over a number of key voices on the ECB Council, including Mr. Curre and Mr. Villeroy de Galhau, as well as the usual hawks. But in terms of the Fed, we have 100% probability, basically, of a rate cut next week. And we are still pricing in quite a lot of rate cuts to come. But if we look at the euro-dollar chart, which is my next chart, this is the December euro-dollar future. What we can actually see is the market has started to push back. So we've taken out one of the rate cuts which had been anticipated, and we may indeed take out more. Not that I'm expecting the Fed not to deliver next week, but the message, I think, particularly given the signs on the US economy, regardless of whether US retail sales are weak or not, are actually not that bad. So what we have as a situation, if we go to my last chart, is we're getting a lot of toing and froing in terms of expectations on central bank policy. We're getting a lot of toing and froing, even more so on US-China trade negotiations. At the moment, they're more conciliatory. And what we're seeing is a lot more spiky volatility. And that spiky volatility is precisely the big weakness as we start to head towards Q4. So those are the thoughts for this week. It's going to be a much choppier ride from here on in, regardless of the amount of monetary easing that we get.